So what happens if I get a reverse mortgage and someday I owe more than what my house is worth? Well, this is a very common concern I hear when discussing reverse mortgages. And so today I'm going to explain one of the most important consumer protections that are built into a HECM reverse mortgage. And it's called the non-recourse feature. So let's break down what that means in plain English. So first of all, a HECM, which stands for Home Equity Conversion Mortgage. It's the most common reverse mortgage that's out there today, and it's insured by FHA. It's designed for homeowners age 62 and older. And so unlike a traditional mortgage where you're making monthly payments and then reducing the balance, a reverse mortgage allows you to convert a portion of your home's equity into cash, and then over time, interest accrues on the outstanding balance. And so because of that, there's a lot of homeowners out there that wonder, what if the loan balance eventually becomes larger than the value of the home? And so that's where the non-recourse feature really comes into play. And so the non-recourse, it just simply means that neither you nor your heirs can ever be personally responsible for repaying more than what the home's value is when the loan becomes due and payable. So let's just use an example. So suppose you have a reverse mortgage and the balance is $400,000. And then years later, after interest is accumulated and accrued, the balance then grows to $500,000. Now let's just say that the housing market declines and now the home is only worth, let's say, $450,000 when it's sold. So many people assume that the family, or the heirs, would have to then come up with the additional $50,000 to the shortage. And that's just simply not the case. Because a HECM is a non-recourse loan, the lender can only be repaid from the value of the home. So if the home were to sell for $450,000 and the loan balance is $500,000, the FHA insurance fund covers the gap or the difference. The heirs are not required to write a check. The estate is not responsible for the shortage. The lender cannot pursue any other assets. And so this is really an incredibly important protection. And so now let's look at the opposite scenario. So let's just make an assumption that suppose a reverse mortgage balance is $300,000 and then the home is worth $500,000 when it's sold. So that remaining equity belongs now to the homeowner or the homeowner's estate. So the lender does not get to keep the extra value. Your heirs will then receive the remaining proceeds after the loan is paid off, just like any other mortgage that's out there. And this is where a whole lot of misinformation exists. Many people believe that the bank automatically is going to get the house, and that's just simply not true. The home is going to remain owned by the homeowner throughout the entire life of the reverse mortgage. And so when the last borrower, assuming there's a couple, if the last borrower or there's only one borrower permanently leaves the home, they pass away, they sell the property, the heirs then typically will have a few different options. And so the options that they have is, one, they can sell the home and keep any remaining equities we just described. They can refinance the reverse mortgage balance and keep the property if they choose to do that. They can purchase the property themselves at no more than 95% of what the value is, or they can walk away from the home if it's worth less than what the loan balance is. And so that last option is possible because of the non-recourse protection. So if you think of the FHA insurance as a safety net, you'd be right on. The homeowners pay mortgage insurance premiums throughout the life of the loan, and one of the reasons that the insurance is there is to provide this protection against future losses in the event that the loan balance exceeds the property value. The non-recourse feature is one of the reasons that many retirees will feel more comfortable using a reverse mortgage. as part of their retirement strategy. So it provides access to home equity while at the same time protecting both the homeowner and then their family from the future market uncertainties. And so the bottom line is pretty simple. With a federally insured HECM reverse mortgage, you can never owe more than what the home is worth. And so the heirs cannot inherit a reverse mortgage debt that exceeds the value of the property. And really that's probably one of the strongest consumer protections available in mortgage lending today. So if you have questions about reverse mortgages, home equities or HECMs, or whether this might fit into retirement goals or someone that you love dearly, I'd be happy to walk through your options and help you then understand how this whole program works. And if you found this content enjoyable or valuable, please like and share or follow my channel.